Dividends are never guaranteed, but you can buy your way to the front of the line. Preferred shareholders have priority over regular shareholders, and their income is more predictable. Today, we'll look at a fund that holds preferred shares from about 200 different companies, pays an annualized yield of more than 8% monthly, and has recently performed more like a tech stock than a boring old fixed income investment. If you like consistent income, PFFA might be worth a look. Let's start with PFFA's income. That one-time spike up to 55 cents back in 2019 looks rather odd. I couldn't find an explanation for it, but my assumption, given that interest rates were declining at that time, is that the fund sold some fixed-rate preferred shares for a profit. A few months later, another surprise, this time a bad one. The global pandemic led to a dividend cut from 19 cents down to 15 cents. That's obviously a negative. The less obvious changes were some small increases, from 15 cents to 16 cents per share per month at the beginning of 2021, and then quarter-cent raises in January of 2022, 2023, and 2024. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and the one we're looking at today definitely qualifies at just over 8.5%. And if you'd like a copy of my portfolio, it's called Armchair Insider. Link in the description, it's free. This total return chart shows a more complete picture than the income alone because it includes price changes and dividends reinvested on one chart. Once again, we're going back to PFFA's inception in May 2018. Prior to the pandemic, it went straight up except for this little dip here. Once again, I couldn't find an explanation for that, but it does coincide with the Fed raising interest rates in 2018, which hurts the value of fixed-rate preferred shares. Then in Feb 2020, it fell off a cliff because of, well, you know what. The market was fearful of dividend cuts, as we all were. Actually, it turned out that there weren't many cuts, but the fear was real. That drop didn't last long though, and the recovery was quite strong. Everything looked great until the Fed began a new round of rate cuts in early 2022. Once again, fixed-rate investments lose value when the Fed raises rates because some investors ditch preferred shares to buy risk-free treasuries. A relatively volatile and slightly negative period followed until late 2023 when the market believed that rate cuts were actually coming soon and PFFA took off like a rocket. If you're still watching, you probably think we're unlikely to face another pandemic or rate hikes in the near term, so conditions should favor PFFA. At least that's what I'm thinking. So let's take a look under the hood and see how this fund makes money. The Virtus InfraCap US Preferred ETF, ticker PFFA, holds just over 200 preferred stocks. These are like a hybrid of common stocks and bonds. Of course, income investors are usually drawn to the regular or common stocks that pay dividends, and some companies have a reputation for paying consistent dividends, but they're not obligated to pay anything. During tough times, cutting or suspending the dividend is always an option. By contrast, preferred stocks also offer dividends, but the amount paid is determined in advance. It typically begins as a fixed percentage of $25. For example, 6% of $25 equals $1.50 per year. Some preferreds will remain fixed, and some will switch to a floating rate after a few years, say 5 years, for example. If that switch happens, the dividend paid will start to vary over time, but unlike common stocks, the dividend won't be determined by the company. It'll be determined by short-term interest rates. Preferred shareholders receive preferential treatment under two scenarios. First of all, they're first in line to receive dividends. If a company wants to reduce or halt its dividend, only after completely eliminating the regular dividend can a company consider cutting the preferred dividend. The second scenario is if a company goes into bankruptcy and its assets are liquidated, preferred shareholders are prioritized over common shareholders to receive a payout. Now, that second scenario isn't really as meaningful because preferred shareholders' claim on company assets still falls below the various holders of debt. So, to summarize, I think the most important benefits of preferred shares are, number one, a more predictable income stream, and number two, having priority over common shareholders to get paid. The 8+% yield from PFFA is higher than the average yield on preferred stocks. They achieve this above average yield with the use of 20 to 30% leverage, and leverage is, of course, a mixed bag. The higher yield is nice, and the cost of borrowing will come down with interest rates coming down, so that will help PFFA's net investment income. On the other hand, when the market goes against PFFA, leverage amplifies the losses. On a related note, the interest paid to leverage the fund is mixed in with PFFA's expense ratio. So if you see that 2.52% expense ratio, which does look crazy high, remember that most of that is interest and the management portion is actually 0.8%. Though some preferred shares distribute the more tax-efficient qualified dividends, I couldn't find any evidence that PFFA shareholders receive qualified dividends. This summary of the past 5 years of financial statements from PFFA showed a small amount of capital gains and some return of capital. I also looked through some 19A notices from PFFA and couldn't find any reference to qualified dividends. So, in summary, unless otherwise proven, I'm assuming the vast majority of PFFA income is taxed as ordinary income. Analyzing preferred shares is quite a complicated process. Each one comes with a unique set of terms. For example, they may be callable. That means the company has the right to buy them back from you on or after a specified date, usually at a price of $25. And if you paid $27, that would be a negative. Another common scenario is a switch from a fixed to a floating rate on a specified date. That could be good or bad, depending on where interest rates happen to be at that time. Monitoring these rates and changes is too much work for most investors, so they either just don't bother or they only hold a small number of preferred shares. Apart from the yield, here's what I like about PFFA. I read a few articles comparing various preferred share funds, and in each case, PFFA came out on top for total return. This analysis by Double Dividend stocks on Seeking Alpha is a good example. If you're an income investor, Seeking Alpha gets you access to more research than any other website or app. I'll put a link in the description to Double Dividend's analysis of PFFA and a link for a free trial and a discount. I'll also link this video that walks you through the 4 features I use to analyze income investments. Even though PFFA generally follows the same direction as the stock market, it's not an exact correlation because it's also affected by interest rates. For this reason, it does offer a little bit of diversification from, say, an S&P 500 covered call fund. The price of both asset types would take a hit during a market correction, of course, but the effect on their income wouldn't necessarily be identical. Here are the risks and concerns I have about PFFA. Preferred shares are known for their low volatility, but PFFA's use of leverage doesn't just juice up the yield, it also increases volatility. Even though the income has been fairly consistent, the price action can get fairly wild at times. The majority of preferred shares are issued by companies in the finance, real estate, mortgage REIT, and utility sectors. Even though PFFA gives you plenty of diversification across companies, it does limit you to specific sectors of the economy. If you don't like leverage and or you want to pay lower fees, you could get exposure to preferred stocks through an index fund like PFF. It's managed by BlackRock, and with over $15 billion under management, it's more than 10 times bigger than PFFA. It also has a much longer history going all the way back to 2007. PFF might be a good fit for a more conservative investor, but I don't hold it because the yield is only 6%, and more importantly, when comparing PFFA with PFF since PFFA's inception in 2018, PFFA has a total return that's more than double PFF. To PFF's credit, it did suffer a smaller drawdown during the pandemic. My conclusion from comparing PFF with PFFA is that it's worth paying the 0.8% management fee for PFFA's active management. Instead of blindly following an index, they can adjust the portfolio based on changes in interest rates and what's happening in various business sectors. For example, compared to its benchmark index, PFFA recently went much heavier into real estate preferreds and lighter on financial companies. A passive index can't do that. I started buying preferred shares in 2023, and my plan was to educate myself on them and gradually build a basket of individual preferreds that would someday make up about 10% of the portfolio. Well, since then, I've learned that there are just too many moving parts for me to monitor. The call dates, the switch from fixed to floating, the impact of the Fed funds rate on floating rate payouts, and all that kind of stuff. It was just too much. So now my strategy is to weight more heavily to a fund, specifically PFFA. I still occasionally buy individual preferred stocks if they're particularly attractive, but in smaller allocations. Now, if you're the analytical type of investor, then perhaps you'd enjoy creating your own basket of preferred stocks instead of paying a fund to do it. If that sounds like you, then Quantum Online provides a nice summary of the terms for each preferred stock. Or if you're just curious and you want a free course on how to analyze preferred stocks, this guide was written by the REIT Forum, a newsletter about REITs and preferreds that I subscribe to. Links to both are in the description, and they're both free. After a 25% run-up in price over the past year, PFFA is no longer a bargain. Looking back at the yield over the past 5 years, we can obviously see where the yield spiked up to 24% during the pandemic. I don't see that happening again. The lowest point was 7.35% yield back in 2021 when interest rates bottomed out. Over the past 12 months, as the price has risen, the yield has been trending back down towards that 7.35% number. When the current yield of about 8.67% falls below 8%, then I'll probably consider selling. This yield history chart came from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, check the yield on cost, and most importantly, know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. Even though PFFA had a good year, I don't see that repeating over the next 12 months. I think the market has priced in most of the benefits of falling interest rates on fixed-rate preferred shares. At this point, I continue to hold PFFA for the yield and the diversification away from the S&P 500 and tech stocks that dominate, well, frankly, most funds. PFFA gives you access to a lot of preferred stocks with just one click. And if you want exposure to other sectors like BDCs or real estate, this video covers 4 other funds that give you easy exposure to high-income asset classes. That wraps it up for this look at PFFA and preferred shares. More Armchair Income coming soon. Armchair Income.